Obviously, everybody is waiting to see the scheduled issuances by the Debt Management Office. But again, that caveat where we've been told that the government intends to reduce its borrowing. How does that reflect?
Well, yes, the government has said borrowing this year should be about 790 billion. The first quarter's auction calendar came out late last week, and so far the first auction happened on Wednesday, and the amounts issued was significantly less than the calendar had suggested. 74 billion issued versus 80 to 100 billion. So I mean, it's so far this year, I mean, borrowing is less than last year. Right. But again, you need to see this sustained over time.
Obviously, what we've seen on the fixed income side are very attractive yields. Does that trend continue?
Well, we have been seeing a reduction in the DMO bond yields from the peak of 18% for the 2018 bond in October. It had come down in November and December. Unfortunately, that trend was reversed this week, with that 2018 bond going for about 16.9. The question is whether it is a one-off or whether it's a new trend that the rates are going back up. Yeah. Also, when you couple it with the very weak demand at that auction, maybe the rates are really not going up, but they just had a very poor showing on that day.
All right. Now, with the rates still fairly high, the issue is how that's going to have a bearing on subnational bonds and also on corporate bond issuances, those coming to market.
Well, it's going to be a bit difficult, I mean, to price right now. I mean, if the federal government is close to 17%, where does that put everybody else? A number of issuers will negotiate directly with buyers and try and get rates lower, but how much lower can you get? I mean, one state did manage to pull off a 14.5 when the DMO was issuing at 15.93, but there's only a limit to how much the market can absorb below federal government rates. So most likely nobody will be rushing to issue, I mean, in Q1, given this kind of rates. But there's no guarantee that these high rates will be sustained for the rest of the year.
I mean, just what we're likely to see by way of interest on this side of the market. We know that when UBA came to the market, it was effectively the 13th of the corporate issuers coming to market. We've got a problem of not enough new listings on the equity side, but businesses, states are coming to market nonetheless. Is there just going to be enough liquidity? Is there going to be enough subscription?
Well, there is enough liquidity out there. I mean, everybody talks about the 2 trillion plus sitting in the PFAs, pension funds, of which about 30% can go into different kind of bonds. So the demand technically is there. The problem is that you're competing against the very liquid federal government who is prepared to issue at whatever price the auction prices them at. And some of these high quality issuers are not prepared to pay just about any price to get a bond issued. So there's that constant battle between going for a high-price bond or just getting some kind of bilateral lending from somewhere, local or foreign. So far, the lending is winning, but I mean, there's no guarantee that we'll have these high rates towards the end of the year. So maybe some people should start in the bond issuance process now, so when they need the money, they'll be in a process to issue.
All right, so Tuesday we'll be looking at the central bank and the decisions taken by the MPC. We do know that the central bank governor is concerned about inflation rising by mid-year, saying you could probably see it at 14%, but at the same time he doesn't want to strangle the economy by hiking aggressively interest rates. What do you think we're going to see next week?
Well, I think for the first meeting of the year, given all the things that happened in January and a lot of instability and uncertainty in the system, it'll be surprising if they make any move at all next week. Yes, I mean, inflation is projected to go up, but December numbers came in less than November, 10.3 versus 10.5. So, I mean, they probably have to wait 1 or 2 more months to see if there's really any increased trend in inflation. We're hearing different stories about reduced demand. So there's really no way to tell exactly what the inflation trend is. But given the huge hike last year, I mean, January last year, MPR was about 6, closed the year at 12. They might just want to give the market a bit of a breather to absorb these new higher borrowing costs before making any further moves.